Well, thank you
Okay, let's do it.
everyone for joining the Angel Investors panel at Digital Resi January. We're actually at the last panel of the day, and I'm really excited to introduce these great investors who represent a great diverse different organizations who actively invest in early stage life science companies, and looking forward to all of the insights that they have to share. Special thanks to Jeff Arnold for moderating the session. I'm gonna cut it short and let Jeff do all the talking from now.
Thank you, Claire. Under normal circumstances, I'd be saying that I know that we're standing between you and the cocktail party. But I guess we're not. I wanted to thank and welcome my co-panelists, Norm Giddis of Life Science Angels, Ozan Isanak of Keiretsu Forum Canada, Prasna Ramesh of Maple Leaf Angels, and Yaniv Senior of Mid-Atlantic BioAngels. Now, I know I speak for all of my panelists, all of my co-panelists, that we didn't get into life science investing just because of the economic benefits. We did it because we want to help. We do it because we want to help people. And so our goal in this next hour or 50 minutes is to help everyone in the audience navigate the maze of how to raise money from angels. And we hope we accomplish that. If at any point you have questions which we haven't addressed, please write them in the chat screen and we will do our best to address them. So with that, let me have the panelists introduce themselves and tell you a little bit about their group. Panelists, please explain what sort of investments you make, how many life science investments you make in a year, the approximate size, both with and without syndication. Norm, if you would start, please.
Sure, thank you. By myself, I've been here in Silicon Valley, California for just over 30 years, started successfully, exited 2 high-tech companies, and became a venture investor 10 or 11 years ago, and have been investing only in life sciences, medical devices, and therapeutics. And we set up a relatively small fund called Lima Ventures, which is only a $25–26 million fund. And because it's a relatively small fund, we have very close collaboration with 2 angel organizations, Life Science Angels and Band of Angels. And I happen to serve on their screening committees. Life Science Angels has about 130–140 members, and it invests in all types of life science startups, devices, pharma, biotech, digital, and it invests in about 12 deals per year. Out of them, maybe 6 follow-up rounds and 6 brand new deals. And the average check size is, when it is a brand new deal, the check size can be somewhere between $200,000 and $500,000. If it is a follow-up round, the check size tends to be larger, all the way to $2 and slightly exceeding $1 million. So that's what LSA is doing.
Great, thank you. I'd point out that when Norm says a check size of $500 to $1 million, that isn't the total round size. That often we syndicate across angel groups, and rounds can be up to $4 or $5 million. Yaniv, if you would describe a little bit about yourself and briefly about Mid-Atlantic BioAngels.
Sure, thank you, Jeff, and thank you for having me on this panel. My background is I originally studied physics in university and ended up becoming an entrepreneur, and have started, run, turned around, bought, sold a bunch of companies, and at some point like many of you, became a consultant as well as an investor. So I'm one of the founders of Mid-Atlantic BioAngels. Most of our members are from, I guess, the Mid-Atlantic area, from Maine to Massachusetts, although we have people who, excuse me, from Maryland to Massachusetts, although we have folks who come in all the way from Texas sometimes for our meetings. We invest exclusively in the life science space, and within that, only sort of the deep end of the pool. So we only do therapeutics, devices, and diagnostics. Because of that, the majority of our members are usually from within that industry, whether they're MDs or people who are working for pharma. We also have a few pharma and device companies who are members of our group as well. We invest as individuals. We've also formed internal pools that invest where our individual members, the majority of them are members of those pools, and the pools go in by a vote of their members. And we also have a sidecar fund for people who want to index our investments. So usually most of our check sizes are between 250,000 to $1 million per round per our group. We are happy to syndicate with other angel groups on things that we do invest in, and we invest all over the world. So that's pretty much us.
Pratna, if you would briefly tell us about yourself and your group.
Sure. Hi, Jeff. Hi, everyone. It's a pleasure to be here. My name is Pratna Ramesh. I serve as Managing Director of Maple Leaf Angels. So we are a Toronto-based angel investor network. Like Yaniv, we also run a fund. The fund is MLA 48, and the thesis of the fund is to make investment decisions in 48 hours. So that's a lot of due diligence, intense work being compressed in 48 hours. But we have fun, and the reason we created the fund is because we recognize the amount of time entrepreneurs waste and spend on fundraising. So I would classify MLA as a generalist investor. Over the years, we've invested about 40 million into about 75 companies. And in our overall portfolio, about 16% of which is in the life sciences, digital health, or biotech and telemedicine space. Other areas we look at are obviously clean tech, enterprise software, fintech, etc. In a year, we receive close to 800 or so proposals, and we make roughly 15 investments in a year, with about 1/3 being in the medical space. We participate in both initial and follow-on rounds, so oftentimes we will exercise our pro rata rights in a company's Series A. Our life sciences investments have typically been at the low end at 200K and at the high end up to 4 million. And the total round participation sizes have sat somewhere along that in the $2 to $5 million range. On occasion, we'll do some rounds which are in the sub $1 million range.
Pratna, thank you. I'm going to syndicate with you. $4 million in 48 hours. That's wonderful. Ozan.
Imagine the pressure.
Please.
So my name is Ozan. Thank you for having me here. My personal background is venture capital and private equity. I have acted and also do act as both LP and GP at various different entities, both primarily in Canada and the US. Specifically with Kretsu Forum, I've been investing as angel type of investments, smaller size investments for some time now, specifically on the Kretsu, and primarily through platforms such as this, different angel networks, where you can actually feed off of other people's expertise. And that's exactly what we do here at Kretsu Forum as well. So we specialize in syndication. We are also a generalist investment. However, 30 to 35% of our investments do fall into the whole life sciences category. It's very tough to slice and dice technology, life sciences. They can kind of go merge into each other. Kretsu Forum Global, we allocate around $80 million to $85 million per year into companies. Specifically Kretsu Forum Toronto, where I'm based right now, we allocate about $12.5 million per year. So when you average it out, it's about $1 million a month, but it's usually, it's not $1 million a month, some months are higher than the others. Same statistics over here in Toronto as well. So around 30% or so, 35% is life sciences, of which, not of which, our total deal flow here in Toronto, about 40% is non-Canadian, which means that they're syndicating throughout the network. We're open to syndicating not just through internally through the Kretzer network. We're very open to syndicating through other angel networks as well, and participating in due diligence, etc. The other 60% of our deal flow here in Toronto is Canadian, coast to coast Canadian. So we don't specifically focus in on the Ontario deals.
Okay, well, thank you. And I'll just briefly tell you about myself. I've been doing, I'm a former life science serial CEO, and I've been doing angel investing for the last 15 years. I'm a member of 3 Boston area angel groups: Boston Harbor Angels, MA2, Massachusetts, sorry, Mass Medical Angels, and Sky Forum. The last 2 are completely life science focused. Boston Harbor is about 60% life science. Boston Harbor does about a dozen deals a year, typically investing between $250,000 and $500,000, and as I said, syndicating up to 400,000. So we're all very similar in that regard. So let's move on to the questions. What is the best way for an entrepreneur to approach your group or apply for screening? Yaniv, why don't we start with you?
Sure, thank you. So like many other angels, all of our members have at least one day job. Many of them have 2. So the bandwidth is very limited. And so we ask companies to go to our website, which is bioangels.net, review our investment criteria, and if they think that they are a match, to please submit an application. And then we screen on a monthly basis. So the only time we really get a chance to meet with companies is on a one-to-one basis, is through things like events such as RESI, where we get to meet them, or JPM, et cetera, where we have one-on-one meetings. The rest of the time, we really ask people to go through the process, go to the website, look at the investment criteria, submit an application. And then we screen once a month.
Pratha, how about you?
Yeah, Jeff, I don't want to say, just go to our website, no shade, Yaniv. I think it's important, and our website has a lot of useful resources too. But I often hear from entrepreneurs that they do that and then they don't hear back. So one thing that I do want to say is that where I've seen the angel group and startup relationship flourish the most is when someone in the group of angels has spent some time with you, the entrepreneur, prior to your formal pitch to the investors, to receive some mentorship. And I will say it can be pretty evident whether you have or have not sought out coaching to just better understand your audience, who you're presenting to, and understanding sort of the characteristics of angel investors. So to that end, in addition to our website application, like I'm sure everyone on the panel has, we also host weekly office hour sessions. Essentially, that's a relationship building exercise. And for you to come out and seek mentorship, perhaps 3 to 6 months before you're officially launching your fundraise round. And then what I would also recommend, and this is my personal advice, is once you've had that initial meeting, send regular follow-up updates. And I think investor updates go a long way, especially when that individual hasn't even invested in you yet. We actually spend the time reviewing and tracking companies that might be too early for us and may bring you back at a future point.
Ozan, Norm, do you have anything to add, or has it all been said?
I'll just add something. I mean, generally speaking, most of our deal flow is referral from our members, as well as referral from other entrepreneurs that have, successfully raised capital from us in Toronto. So everything kind of feeds off of each other. So we trust them. We bring everybody in. We'll generally have about 2 screenings per month here in Toronto, and we generally syndicating companies. They don't have to go through deal screening, but they have kind of like a quicker way into our monthly presentations, just because we have vetted them at different regions. In terms of new companies, we obviously have not only deal screenings, but also if they do end up passing, we have multiple pitch polish sessions positioning sessions, etc., so that they're not speaking blindly to our group.
Thank you. Norm, I'm going to move on to the next question.
Okay.
We spent a fair amount of time on this, and there are a lot of questions of us. So why don't you take this one, Norm? What is the level of preparation, proof of concept, team, customer traction, et cetera, that a company should have for a successful first investment with your group?
If you give me a couple of hours, I will be happy to answer. But very roughly speaking, we do not invest in the idea. We invest in companies that have some kind of a working prototype, that have already developed some kind of a proof of concept. If it is a device, we want to see at least a semi-functional prototype. If it is a biotech pharma startup, we want to see some proof on animals or at least on the benchtop. We want to see some kind of confirmation of the preliminary idea. And of course, it's very important for us to see that company understands the target market and company understands the market need and that its offering may satisfy the current market need.
Will any of you guys invest in a high throughput screening opportunity? We've got the biology, but we don't have the lead compound yet.
No.
Yeah,
For us, it would be
That's
too
tough.
early.
Very, very tough.
yeah. So everyone is looking for a lead compound. If it's a therapeutic, they're looking for a lead compound. They're looking for some animal proof of concept. And then
Also, I would say that we will not invest when it's still an idea or it's still in a lab and before there is professional management on board. We
Okay.
want the ship, the professional commercial ship, to be sailing.
let's see. How much should a company raise? What are the parameters? What are the what's too little? What's too much? What's the right amount? How do you decide? And what should the valuations be? Ozan, why don't you take that one?
It's not. I mean, the question isn't how much should it raise. The question is how much does it need. Oftentimes what happens is we get stuck on the deal structure because it doesn't necessarily, first we need to know how much the company needs in order to get to an exit of sorts for us and what that flow is. Generally, when we initially speak with life sciences companies, they present to us a path, but it's not detailed enough, and it doesn't actually account for how much funding specifically at what structures to look for. So we need to start off. It's a relatively complex investment, and it's not a tech investment where it may be straightforward, and it's there's certain special milestones in life sciences investments, and we need to have that slightly more defined at the beginning. I think that's what we generally see. I want to know how much they need, and I want to know how much and what and how they're going to raise it.
Yeah, I'll jump in, Jeff,
yeah,
if you
go
don't
ahead,
mind.
please.
I completely agree with Ozan about milestones, what you really need and your budget, what it tells you. I think the other thing to keep in mind is that your traditional VCs are no longer playing at the earlier stages of discovery and development. And therefore, going to an angel investor, an early stage investor might be your better option. And so in that instance, I think you as an entrepreneur are first going to undertake an exercise of exploration for yourself. Who is the right type of investor for me, and who actually has the appetite to invest in an opportunity that I'm presenting? And as you go through those conversations, you can then start to hone in on your target segment. And then what you'll come to learn is, I think, and I can only speak for our community, angels are probably going to be a little bit more valuation sensitive than the typical VC because it's higher risk. They're getting involved at a much earlier stage. but they would help you figure out some glaring holes fairly early on. And, the whole topic of valuation is a very interesting subject today. And if you're in the startup world, you're obviously tracking the global trends. They've reached astronomical levels. And then with COVID, there was a mild correction downwards. All to say, your evaluation, I truly believe, is the price that the market is willing to pay for it. So, the last thing you want to do is to get stuck on a number, as Ozan pointed out as well.
So Yanni, let me pose, I got presented today with a plan. This was a company that had two lead programs, one of them slightly ahead of the other. They wanted to raise $1 million or so in a bridge to move the programs along a little bit, and then they wanted to raise $20 million. And
I know why
I gave him some advice, and I'd be curious what your advice would be in that situation.
So let me jump on a couple of points that were made before that I want to answer your question. So first of all, I think that you have to remember as a CEO that's going to take you between 6 months to 18 months to raise money, and you don't want to be constantly raising money. So you want to raise money for at least 2 to 3 years of operations, so that you're not just operating, you're just not raising money, but you can have some money to operate as well. And in the question of valuation, you have to remember that there needs to be an attractive multiple for investors. So whatever your valuation is, it has to provide for a reasonable, realistic multiple that's attractive to investors. With that said, if you're going to raise $20 million, and going back to other points that were made, the amount of money that you'll need to raise in total will determine the kind of money that you go for. Each one of us had mentioned that usually we invest in rounds of $2 to $5 million, which is typical and possible with angels. But you can't, if you need more than that, then you need to go to VCs. And if you need more than $15 to $20 million, which is what you can do in multiple syndicated angel rounds, then again, you need to go to VCs. We happen to be a group that prefers not to invest ahead of VCs. So if we see an opportunity that's going to require, as you said, a bridge now for a VC round later, we would recommend to the group to go to the VCs directly and to see if they could do the bridge with them in anticipation, because someone will invest a small amount in anticipation of the larger round later on, but we do not want to be those investors.
It's interesting. I have the same view. A lot of angels jump on the opportunity to invest in the bridge, but personally, I prefer to not to rush with the bridge, and as long as it is a bridge to nowhere. I want to see where this bridge will lead to. Who are the potential institutional investors in the upcoming round? What are their criteria? How can this bridge help the startup to meet and exceed the criteria that would make it attractive for the institutional round? So bridge is, I agree with Yaniv, bridge is a risky thing because one needs to analyze what is this bridge going, where does it lead you to?
Yeah, let me jump in. Oh, go ahead.
Yeah, from an investor point of view, that you're right. I mean, both Norm and Yaniv, you guys are right. It's bridge is risky, but it also comes with different types of, at least specifically for the investor, you can negotiate different terms on the bridge, and you can push the company to negotiate if they require a bridge. But Yaniv, I agree with you. I generally we would expect them to go to a VC and get them to finish off a bridge, and then to us pull it together.
You can,
but it happens.
You can try to negotiate right now, but whoever comes in with that $20 million is going to set the
right. Whatever you negotiate out the door.
So I'll tell you what I told this entrepreneur, which is most angels won't invest in, as you guys have said, most angels won't invest in a bridge where the next round is $20 million and needs to be a VC round. And most VCs won't invest in $1 million round. So you are not going to finance your company that way. And it turns out that he really needed $2.5 million to get IND ready on the first program. And then he needed $4 or $5 million to do a phase 1 trial on that program. And I said, that's what you should raise. And those are numbers that angels will raise for you. And I also said that, as you guys have pointed out, it takes 6 to 18 months to raise money, but it doesn't for the second round. So if you're already a portfolio company and we've invested in you and you're doing well, it doesn't take 6 to 18 months to raise your next round. That comes pretty quickly. And so with angels, you don't need to raise enough money to have a big runway. Once you meet your milestone, it's easy to raise the next. Anyway, that was my advice to him. We'll see if he follows it. If I'm a first-time CEO, what would you guys recommend I do to prepare for angel investment? Pratna, why don't you take that one?
Yeah, I would just keep in mind that a good angel investor will probably be noses in, fingers out. I think you hear that expression. They'll stick by you when things are good and bad. What I will say is you definitely want to date before you marry. I've seen matches with angels being nurtured for up to a year before a formal relationship is struck. And you might also find, some angels that are more of the passive variety that are interested in writing a check in your company. So I think understand what you're working with, understand the characteristic. Ultimately, they're all individuals you're dealing with. And then I would approach the discussion as managing expectations accordingly. To summarize all of this, have more than one conversation with your angel investors before accepting their money, aside from the typical pitches that you go through. Too many times have I seen, yep, you've got a check, let's take the money and run. You have no idea sort of the amount of value that you can get, even if on paper the person might not have, let's say, a medical background. They may have tremendous functional expertise and value that they can bring to your company.
So why don't I ask, how would you go about getting mentorship if you've never run a company before? Norm, how about you?
So you just be proactive, approach, develop relations with incubators, relations with active angel investors, and find a good chemistry with people who are happy to mentor you. There are a lot of angel investors, and I would say majority of angel investors, at least that I am seeing, that will be happy to mentor a new CEO, a new founder, that will be happy to share their ideas, their knowledge. And it's matter of CEO being proactive. And I agree with Pratna that if you want to approach angels, VCs, whoever, if you want to start raising money, start from developing relationships. Talk to them, find people who will like you and your ideas, who understand your market niche. Develop the relationship, listen to their advice, work with them, and they will help you to go through the screening and all the steps of the investment process.
So maybe we'll pause here for a moment and take some questions. Claire, could you, a lot of the questions have been answered by the panelists in the chat, but some have not. If you can find some, would you read them to us and we'll have the panel address them?
Yes, absolutely. So let's see. So the first question that I could see is the following. So if you invest in therapeutics, what are the top 3 things you look for?
Who wants to grab that? Yaniv?
Okay. I always have a problem with the top X kind of response. We always, the first thing that we always invest in is the management team. I think one of the big differences that many people will realize, but the difference between VCs and angels is, since we do have at least one day job, we don't have an interest in running your company, nor do we have people who are waiting to jump in and run your company. And
Okay, let me
so-
stop you there. That's one. Norm?
That's one, okay.
One from you.
Thank you.
Norm, what would you add? Top three.
As I said, I want to see some proof of concept. Not an idea, but idea with a proof of concept.
Ozan, have anything to add? Top three.
All
We got
right,
two.
we've got number one, Yaniv, number two, Norm, number three is deal structure. I want to be able to get into the right deal because I know that they're going to be going for larger rounds in the future, etc. What that process is, what that pathway is. That when you combine with what Yaniv said and what Norm said, you have a better picture of an investment, and it's not just a blind investment.
Pratha, you have any to add?
It's
I realize we
related
only got
to
asked for three.
let's a bonus one here. Related to Ozan's, all I would say, your exit strategy and your path to that ultimate success point. What is your objective in 10 years time and in 20 years time? As long as you have thought that out, it's going to change for sure with time, but some clarity as a CEO that, hey, this is important to us, and because we know it's important to you as an investor.
So I'm going to add one of my own, which I've learned over the years is you need to get both an efficacy signal, both a safety signal and an efficacy signal in phase one. So if it takes phase two to prove both safety and efficacy, and phase two is really expensive, that bigger than we can afford, then there's not a big valuation step up when we prove safety in phase one. It really takes $25 million to get to human proof of concept. But as in cancer, you can do your phase one on cancer patients and you can get an efficacy signal. And the only exceptions to that are the phase two is inexpensive, there's lots of grant money that's going to pay for the phase two. But if it takes $25 million to get clinical proof of concept, it's out of the range of what angels can do. Claire, any others?
Yes, let me read one more question. So the next question is, what are the typical valuation ranges for each group's investments, and how does this differ by technology? Like, for example, drugs, devices, diagnostics, healthcare IT.
Let's grab that.
So most angels prefer so-called early stage and low valuations. So most angel organizations want to see valuations under $10 million, and they're most excited when valuation is under $5 million. But it's really stage dependent. If it is a very early stage, maybe valuation of 2 or 3 million is good enough, is good. But if it is a later stage company with a lot of proof in the pudding, maybe valuation $15–20 million is acceptable. So valuation has to be considered together with the stage of the company development.
I think you nailed it, Norm. I'm not going to ask anybody else. Claire, any others?
Yeah, we actually have a lot of questions coming up.
Keep going. Yeah, they're good questions, so keep going. Better than I've written.
Yeah, so next question, it's actually from the same anonymous attendee. What is the typical timeline and path that each group prefers to exit? So for example, early exit via acquisition, sequential spinouts, or IPO?
Who wants to take that?
I could jump in. We usually prefer to see M&A activity. We look at timelines, so we do exclusively life science opportunities. So everything in life sciences we expect to happen within 5 to 7 years. Were other parts of that question? Timeline and Claire?
Oh, sorry?
What were the other parts of the question in terms of timeline to exit?
Oh,
Mostly by acquisition and 5 to 7 years.
right. So the next part of the question was more like, yeah, like the typical timeline and so path that each group prefers to exit. So I think
I think you nailed it.
Yeah, I think you nailed it.
It's almost all the time an M&A deal.
I have had a couple IPOs, so it's not all the time.
Good for you.
So let me take over and ask one question. Would each one of you tell us a pet peeve? Please, entrepreneur, don't do this. Norm, why don't you start?
When I ask you a question, what is the market need, and have you talked to the customers, please don't tell me that you spoke to your professor and your professor believes that there is a big market need. Please do your market research. Please talk to as many market participants as possible, and preferably much more, and try to figure out what exactly is the market need. And in the eyes of different market participants, payers, payees, whoever, and come up with justification of why is your product a good fit to the particular market need.
Okay, Ozan, briefly, one
Very,
pet
very
peeve.
quickly, the biggest bottleneck that we have that kills deals is entrepreneurs do not follow up with the investors. We provide them with every type of information to connect with our investor base. 3 weeks down the road, where we are like, they come back to us. They're like, yeah, I didn't get much traction. Well, when was the last time you connected with the investors? What's going on? You say, oh, I didn't have enough time to connect with them and I was busy. Well, you know what? We don't hand capital on a silver platter for you. There is a back and forth that needs to happen, a relationship that needs to happen. If you do not follow up, your deal will get killed. Simple.
Okay, thank you. So we got market, we got follow-up. Prasna, what's yours?
Yeah, I really don't like it when entrepreneurs are wishy-washy on their deal terms. It's completely okay to come into a conversation saying, hey, this is my ideal target and I want to work with you to arrive at a number. However, we just experienced one recently. They put out a number, they reconsidered for a while, came back with another number, and then went back to this other number. It just did not sit well with us at all. And for that reason, we're left with a sour taste on the naivete of the team.
Yaniv, pet peeve.
So I have a bunch of them, but I'm going to choose my top. I'm going to choose my top one. But I'm happy to discuss several.
Well, give us one.
I'll give you one, and that is married or related founders. You know, whenever you bring family into the business, you bring an element that, in my opinion, does not belong there. You know, because people then have to worry about what the dinner is going to be like around the Christmas table or the Thanksgiving table, rather than what's good for the company.
Yeah, I got burned on one of those.
Yep. So that's one of my pet peeves.
Okay, I'm going to give you one because I got fed it twice today, and that is, I hate when somebody shows up and says smoking causes a 7 trillion cost to society, or there are 10 million people with heart disease. I hate it. Unless you're going to, so first of all, society doesn't pay for your problem. Insurance companies do, or individuals. And the fact that society has a cost doesn't mean that you're necessarily going to get reimbursed. It's what is the cost to insurance companies and what are the economics for them? And unless you're going to cure all of heart disease, don't tell me how many people there are with heart disease. Tell me how big the market is for the very thing that you're going to do, which you can get proof of concept in, prove clinical efficacy, and prove that you're cost effective.
And then on top of that, Jeff, on top of that, Jeff, they're going to say to you, but if I can only get 1% of all of those people.
Okay, yeah, no, if you had another one.
That was one of them. The top.
It was?
You know, the top to bottom analysis, when people say that's the size of the market, and if I only get 1%, think how many things how much money I could make.
Okay. Maybe we'll come back to these if we run out of questions from the audience. Claire? Can you give us some more?
Sure. So I will, let's see, this question looks interesting. So what will happen to angel investors with these big venture capitals continuing to continue to completing these 50 million and higher seed to series A for early stage assets in the future? So what will happen to angel investors? The question with these larger rounds.
Yeah, I can take this. I think for a while, and this is just my opinion, I think for a while there will remain a gap that needs to be filled. As you say, for a company to get to that $50 million round, it needs some capital. And I think that's really the role in which we all play. People seem to underestimate the value that the angel community brings, but without the initial seed capital, a company isn't reaching that far. It is in some instances if you're quite lucky.
So I'll just add, I've been doing this type of work for the past 20 years, and I've seen the early stage, the angel part of it evolve in terms of expectations, in terms of the documentation, the due diligence, the quality of the due diligence, etc. It's really kind of every year, the bar seems to be going up. And I've also seen VCs that generally didn't do anything below 50 go down to $5 million ranges throughout the 20 years. So there is a blurring of the line, but that doesn't mean it's one group has to take exclusivity. There's always co-investment opportunity. And I think, eventually, the term sheets, we could collaborate even deeper with some of the VCs. And right now, even in our Toronto chapter, we work with some smaller VC and family offices. They tend to send us their portfolio companies. So they're the leads. And then we follow on with them, or we close rounds at that point, the top little percentage. So there are different ways of putting together the deal. I do not see the angel space disappearing, nor the VC space in any way, shape, or form disappearing. But there will be a little bit more collaboration, and I've seen this throughout my 20 years career in this early stage investment.
So, Ozan, I'm going to respectfully disagree, actually. So in Boston, at least, and I think the questioner was alluding to this, most of the VCs in Boston are starting their own companies. They're building them around professors with Nobel Prizes and interesting biology. They're putting together extraordinary teams, and they are betting on a platform that will ultimately produce a dozen drugs. And there's been a great deal of success. And who is not getting funded by VCs are the postdoc from a lab who is not, where the professor does not have a Nobel Prize. And he's come up with a really wonderful invention or drug or whatever. And it's not a big platform, but it is a really valuable asset. And most VCs are not investing in that, and angels are. And then a dear friend did his PhD thesis on angel and VC investing in biotech, and what he found was that only 8% of angel deals ever attract VC money. So the crossover, the number of times that angels invest and then VCs invest is 8% of total angel investments in biotech. They are separate universes. And we syndicate with some corporate VCs, and we syndicate with some family offices, but to a large extent, the Third Rocks and the Fidelity's changed their name, I forget what they are now. But the VC funds with billion-dollar funds, we don't talk to them. They don't talk to us, we don't talk to them.
So would it make sense for us to syndicate even more amongst the angel groups?
We do.
Yes. And it would, and I didn't know you guys did, or Pratna did $4 million investments. I have not, I'm glad to have met you both. Claire, so thank you for making these introductions, and please give us some more questions.
Sounds great. Yeah, a lot of the questions do seem therapeutic centric. I'm trying to find something that's kind of more general. Maybe
If
this,
that's what the audience wants, then let
yep,
us address them.
sure. So this is another question. So I think it could apply to a lot of therapeutics companies. So in terms of drug discovery platforms, at which point do you consider the technology validated? So is collaboration with pharmaceuticals enough, or own design molecule in clinics? Kind of give us your idea of what's a fully validated technology.
Yaniv, you want to grab that one?
Well, I think, Jeff, you mentioned that you don't, we asked us in the beginning if we invest in platforms for discovery, and we do not. So we look at assets when you have identified a lead asset, and then we can evaluate what the market is for that, what the opportunity is, what the potential return on it is, how much money it's going to require, how long to get to market, but we do not invest in platforms.
But you will if there's a lead.
We will look at
If there's a platform, 3 candidates, and one of them has animal data, you will invest.
We will, that's right. We will consider the lead and the efficacy and the validity of the lead. Yes.
Yeah, same here.
Yeah, I think it's universal.
As well.
Claire?
Yep. So next question. So is there more interest in over-the-counter or prescription therapeutics?
Prescription.
Yeah, there's one of the reasons for that is that the markets for over-the-counter drugs tend to be very big. And therefore, the size of the clinical trials are very big. And FDA's requirements for safety are very big. And you can make just as much money on an orphan drug with a small market where you charge $100,000 per year for the treatment as you can on something where you charge 50 cents or $1. And the clinical trials are much less expensive, and it's much easier to get to approval. Claire.
Great. So next question. So regarding M&A exits, do you expect seed round CEOs to have a list of strategic buyers at the ready?
Yes. Yeah, I mean,
Absolutely.
every story begins with the end first, right? I mean, especially when you come to us, only reason you come to investors is because we have an interest in an ROI. What is that ROI story going to look like? And if you have people lined up already, especially if you had discussions and they told you, hey, I'm going to buy you when, or I'm interested in hearing from you more, but I need to see X and Y and Z, your story becomes a lot more real.
Yes.
And I would say if
pretty
you found
powerful.
someone like, sorry, Ozan. It was super quick. If you found someone like that where you've had a discussion, be strategic about it and get them on your advisory board or something where they can closely track progress.
And there was a question that was posed. What do you suggest or recommend to a first-time CEO? You have to surround yourself with the right people, and the right people tend to be the people who've actually been through this process before, or have some very significant real connections to a potential exit opportunity. That those types of, even in your presentation, those types of slides are very powerful slides. If you can talk to it, it actually adds credibility to whatever product or service or et cetera that you're trying to build.
So you guys have said it's important to talk to the potential acquirers. Let me ask you this. If I'm a seed level company, it's pretty early. I know who the acquirers are likely to be, and I know what the comparable acquisitions have been and at what stage, but I haven't talked to anybody. Is that good enough?
It's better if you have spoken to them.
It doesn't hurt. It doesn't hurt.
But sometimes it's good enough. Sometimes it's good enough, and we provide this service. We connect you with the strategics and as a part of our due diligence process.
This is not unique to life sciences investment. This is the same thing we ask for a tech or real estate, anything type of investment. We're like, have you spoken to your potential customer? Do you have credible exits? Don't just give me, I'm going to IPO. Do you have credible? Have you spoken? Well, this is the same question we ask for everybody. This isn't a life sciences specific question.
Claire, what else you got for us?
Let's see. Well, so I'm not sure if this is a great question, but I'll throw it anyway. What therapeutic sectors do you invest in? I think I'll kind of put a personal twist on this question. I guess if you have any particular areas within therapeutics that you're interested in, I think that's something that could be helpful for the audience as well.
We are
Okay.
Can I answer it in reverse?
Yeah, what won't you invest in? Is it that what you want?
Every time I see another one of those wound healing, I go, oh no, not another wound healing, opportunity.
Okay.
Very busy space.
Who wants to answer what you will invest in?
We just went into a wound healing about 4 months ago.
Norm?
We are area agnostic. We invest through the entire spectrum of therapeutics and devices.
And we won't do therapeutics.
We'll do it all.
And I'm going to answer that briefly because it's similar to what I said before. If it takes a 10,000 patient trial to prove efficacy, to a phase 3 trial, then it's probably not interesting to us. So a lot of pain, is a problem in that regard. But cancer is easy, and orphan drugs are easy. So it has a lot to do with what the size of the trial is. Similarly, Alzheimer's, depression are all difficult clinical trials to pull off, and you can't get there. You can't get to a phase 2 proof of concept on the kind of money that angels can invest. Claire.
So I'm gonna go back to a question that I kind of skipped. So Ozan kind of covered this in the chat box earlier, but so the question is, so from the sounds of it, you guys, the angel investors, are investing at the same stage as VCs. So the sort of proof of concept you're asking for is the same as most early VCs. Is that really the case?
Who wants to
It
take that?
depends on what is your definition of VCs. If you are talking about major VCs that raise hundreds of $million funds, $billion funds, then they will not invest in so early stage as we invest in. But there are plenty of mini and micro VCs and mid-sized VCs, and there is plenty of overlap between small VCs and angel organizations. In fact, we are actively co-investing with family offices and small VCs. So regarding small early stage VCs, they are not dramatically different from angel organizations. Regarding large, well-established VCs with a lot of money, they come in at the much later stage.
Yeah, there's an implied assumption in that question about what VCs, proof of concept VCs are looking for. And I think our experience is that most VCs are looking for well beyond what that proof of concept. They're looking for phase 2 or assets.
How many times I was told by VCs, "Oi, please bring me an early stage deal. We want to look an early stage deal." Then I bring them what I consider next to the exit, very late stage deal. And they tell me it's a little bit too early.
Claire?
Yep. Yeah, let's keep the questions rolling. So if angels are investing the same size deals as VCs, but at lower valuations and with more individual LPs, why should entrepreneurs take angel money?
Again, there's an assumption in there, but who wants to grab that?
Happy to do it. I think there's a clear differentiation between the angel world and the VC world. And I think that as a company, you realize what kind of money you need based on how much money you need for your runway. So if your runway looks like it's going to take 20, 30, 50, $100 million, then in my opinion, you are a VC deal. If every one of your rounds is 10 or 15 million dollars, then the only place you can reasonably get those are from VCs. However, if your total runway is no more than 15 or 20 million dollars, and it can be broken into convenient, quote unquote, $2 to $5 million chunks, then you have a story that angels can buy into. When angels invest, we do not take control over the company, whereas VCs do. And so the philosophy around the whole investment and the investment thesis is different in that sense. Usually investment rounds are a 20 to 40% dilution, to the company, or 20, investors end up with 20 to 40% of the company through an angel round. So you have to begin with your story, your financial story, and the length of time, and that'll dictate to you really what kind of money you need.
I'll just add on 2 other points. Assuming that you have figured out whatever Yaniv has suggested regarding your actual budgetary requirements, here's 2 other reasons why you would take angel money. One is honestly speed. A lot of times VCs do a minimum of 2 to 4 months of due diligence, and in this sector perhaps longer. And there are programs, and as you know, with our fund, there's a fast decision. But overall, I think the angel community is a lot more agile. And then secondly, we don't have LPs to report to, and that financial pressure of meeting their requirements for their time horizon and the ROI are a little bit slimmer when you're dealing with individuals.
I think we're supposed to be out of time. Can we go over as long as people are keeping asking questions?
I think we do have time for maybe 1 or 2 more questions if we really tried.
Yeah, I did, but I want to ask the panel a question.
Sure.
I want you to think about exits. And when the companies you invested in exit, what % share did the founder own? And then I want you to think about VC exits, and answer the same question. Norm?
So last year we had a small exit in the ENC space, and it turned out that during exit negotiations, during the exit process, we discovered that founder and his team did not have enough to make them successful.
Oh, okay.
So what actually I suggested was that they can take a couple $1 million from the exit value to cover the key employees, to make sure that everybody is very happy. So the rest of the money goes to stockholders. So the way I see it, it's usually VCs are more stringent on it. Angels are more open-minded, and we work in the same industry, in the same space, and maybe this CEO will start another company and will come to us. So again, so we try to make sure that everybody is rewarded properly upon the exit, whether if it's a big exit, then it happens to be natural. If it's a relatively small, tight exit, I believe that we will always make sure that not only the founder, but her or his key employees are properly rewarded.
So I'm going to answer briefly. I've had 9 exits, and I've looked at this, and the founder CEO typically had 25% of the stock at exit for angel deals. And I've never seen a VC deal where the founder owned more than 5% at exit. And most of my exits, the founder made $20, $25, $30 million. And I've never seen that in a VC deal.
That's good.
And that's because the VCs want to invest a lot, and they don't care about dilution.
Yep,
And the
makes sense.
angels want to invest as little as possible, and they care a lot about dilution.
Mhm.
And so our interests are aligned with the entrepreneurs, and VC's interests are often not.
Excellent point.
Agree.
Claire, should we continue? You guys want to continue for another 5 or 10 minutes if people want?
Sure, no problem.
Sure.
There is no cocktail party we're missing.
Yeah, we
Private
feel
club somewhere.
Start drinking at home.
All right. So we still have 39 people listening to us. So Claire, if there are other questions, why don't we take 10 minutes and answer them?
Yeah, sure. So there was a part of the one of the previous questions. There was a part that I didn't get to. So can you talk a little bit about geographic reach? It seems like most of the investors here are US centric. So maybe you could talk about your perspectives about investments outside of the US or Canada. If
Who wants to grab that?
Yeah, I'll grab that just because we're more on the global scale. Although majority of our deal flow is in North America, obviously, we do have a pretty strong presence outside of North America. We do have companies that do come in from outside of North America. Generally speaking, what happens is the North American syndicate companies go out into the Asian markets and the European and the Middle Eastern markets to raise more capital to close rounds. So that's what we're seeing, is that there's more of an export of companies rather than an import of companies. But we do see them. We do see companies from life sciences companies from India, from Europe, Israel, etc., that do come in to our network and raise capital. I mean, at the end of the day, you kind of have to draw a similar picture. You can't really be, off to a left field valuations, but they all tend to kind of mix up into the same portfolio.
Norm or Yaniv,
Can I jump
you have
in?
something to be briefly, please?
Sure, we invest all over the world. The reality is that we haven't made any investments in China or India or other, or we haven't done much in South America, etc. So most of it is Israel, Europe, United States. Interesting thing, we've tried to syndicate with other angels in other countries, and what they prefer is for us to invest in their company, but they rarely want to invest in the US companies or in companies outside of their geographical areas. So, but we, it's the same thing, what's happened in Canada often, but not necessarily with Ozan's group, but in other groups in Canada as well. So, but we're open to invest
Norm,
anywhere
I'm
in the
going to
world.
cut you off and let's move to the next question. I think we've covered this one. Claire.
Awesome. So let's see. The next question I'd like to ask is, so for the group, you guys, which best describes your objectives? So I think this is in terms of investment. So 1, financial only, 2, financial and environmental, 3, financial, environmental, and social.
So the way I see it, we are investors in life sciences because we see the benefits for mankind. We clearly see benefits for the society. Otherwise, we would not be here today, and otherwise we would not be life science investors. So to me, being an active life science investor incorporates doing something good for the society.
I think we'll stop. I think you nailed it, Norm. Claire, what else?
Great. So we just got a new question. So let's see, it's a bit long. So if you have an initial clinical use case, regulatory path, and geographic focus, but also see substantial additional opportunities further out, so in terms of product roadmap, geography, etc., how do you recommend illustrating that you have good, clear focus on near-term deliverables, but also good long-term vision and strategy? That's kind of a mouthful.
Who wants to take it?
I think it's a good question, and apologies if the answer is too superficial, but it really, the strength that lies in you being able to convince your investor in exactly that fashion. This is my execution plan for time period A to Z, and then from then onward, we don't want to be naive about the other opportunities that can occur, and we would like your assistance in helping us identify what's real and what isn't.
Good answer. Thank you, Pratna. I think you nailed it. Claire?
Let's
If
see.
you run out, I have a couple.
Yeah, so this question I skipped earlier, but so what is the typical CEO salary after a $10 million post-money valuation?
Who wants to take that?
Are they looking for a job?
Yeah, I wasn't sure what this person was trying to get to, but
Norm?
It depends. It depends. In some of our portfolio companies, founders, CEOs are taking a very basic salary like 120K because they have plenty of stock and it's their baby. In some our portfolio companies, we hire successful CEOs and their salaries start from higher than 300K and maybe close to 400K. So it really depends on the market opportunity, on the particular situation with the company, size of the company, size of the investment, and stage of the company development.
Good answer. I think you nailed it.
Mhm.
Claire?
I think I actually ran out of questions now.
Okay.
Good.
Then who wants to tell us about a recent investment that you or your group personally made? What was the stage? What was the valuation? What was exciting about it? Norm, why don't you tell them about one we both did?
Okay, so we just co-invested with Jeff in the company that he has been an investor and board member for 2 or 3 years. And I believe Yaniv is also an investor, or at least his organization. Yeah. It's a pharma development, drug development startup. By the time Jeff invested really Boston Harbor Angels and Mass Medical Angels invested really early, and it was too early to our taste. But by the time we invested, they had developed a lot of proof in animals. They tested as much animals as you can find in the encyclopedia of animals. Pigs, dogs, monkeys, rats, and you name it. And all data was positive and valuation was unbelievably low. So we got excited and we co-invested with several within the syndicate of friendly organizations. And I believe the post-money, we invested about 6 million at the post-money valuation of about 15 million. And I believe it's a great potential, very strong team. Team of industry insiders who know what they're doing, strong IP with both issued and pending patents, lots of proof on animals, and very clear market need. And before we invest, we spoke to the professors here in California at Stanford, UCLA, and who are the experts in the field, and they were very big supporters of this technology, of this company. So it was a no-brainer to invest.
So let me add, this is a company with a drug for stroke and traumatic brain injury. It's IND ready. The pre-money was 10, but there's really some conversion of convertibles. So the post-money is more like 20, Norm, actually. And the first investment was about 3 years ago, and I forget how much it was, but it was under $1 million. And all the company had at that point was rodent data, and that money paid for large animal data. And then the company raised another round from angels with a little help from foreign VCs, like $2.5 million, which paid for GLP tox. And so now the company is IND ready. It raised $6 million to run a phase 1 trial with a post money of 20 million. That gives you an idea of what stages we're willing to invest in and what valuations. Now the valuation is a little low for a company at this stage, but COVID had something to do with that. We thought we were going to close in March or April actually, and that didn't happen. And then investors got skittish and we had to drop the valuation to get everybody together. I think we have gone over our 10 minutes over our time. I want to thank the panel. This has been informative and a lot of fun. And I hope to the audience we answered your questions. Claire, thank you.
Thank you, Jeff.
Thank
Jeff.
you.
Great job.
Thank you, everybody.
Great
Bye-bye.
discussion.
Wonderful.
Thank you.
Take care.
Have a good week.